Hello and welcome to the Golden Thumb Rule, the podcast where we decode markets through timeless investing principles that work across market cycles. Well, my name is Kshitij Anand, and today we step into 2026, where Indian markets have left investors with mixed signals. You could say that record highs in local terms, yet among the worst performing globally in dollar terms. Well, to help us make sense of what lies ahead and whether 2026 is about buying growth, value, or probably something in between. I'm joined by Deepak Shenoy, CEO of Capitalmind Mutual Fund, known for his data-driven and rule-based investing approach. Deepak, great to have you on the show.
Thank you so much, Kshitij, and wish you all a happy new year and a fantastic 2026.
Thank you so much for the wishes, Deepak. And Indian market sort of ended 2025 as one of the worst performing markets in dollar terms. But yes, we did record highs, we did everything. There was a lot of glory towards the back end of the year. But what's the first golden thumb rule investors should apply while entering 26?
I think, it's been a rough year for a dollar investor, but it's been a decent year for a rupee investor in that sense for the most, at least the large caps. The Nifty
Yeah.
did close at low double digits, just a little bit more than 10%. And you've seen mid caps and small caps probably take it on the chin. So a lot of the
Yes.
broader base mutual funds, broader S&P, even including the Nifty 500, not the Nifty 50, has
Sure.
not done quite so well in comparison. You've seen perhaps a lot of geopolitical challenges, and I
Mm.
think right till today we are seeing new geopolitical events happening at a magnitude we have
Mm.
not earlier seen, and then not much happening on the markets in terms
Mm.
of a reaction as well. We don't know the answers to where any of these things will go, but I
Mm.
think we shouldn't try to even a predict them, and b try to predict the market's reaction to them. So
Sure.
we don't know where the markets are going to go. The most important thing here is, are earnings coming back? Is growth coming
Mm.
back? If growth is coming back, and we are seeing early signs of it after the GST cut and perhaps after the
Mm.
RBI rate cut, the government has also announced a bunch of PLI schemes and so on.
Mm.
If earnings actually reflect the change,
Mm.
then I think the Indian markets are in for a positive move
Okay.
on the back of earnings. So even
Mm.
though you might say that this year has been ordinary,
Mm.
Indian markets have not become cheap in that
Yeah.
sense. But if earnings were to go up, then
Mm.
markets would become relatively cheap at these levels, and therefore, you'd get a bump up just because of that. And then it's the domestic savings, the domestic investments that are propelling this, move forward.
Move
It's not
forward.
the foreign investors
Mm.
for a change. So I think to that extent, things have changed. And when you approach 2026, it should be primarily with the view of, can I see an improved
Mm.
earnings growth
Correct.
in companies that I want to invest
Companies.
in the
Right.
funds that I want to invest in? And
Sure.
overall, that is your, guiding or North Star, if you may.
If you look back, we did hit record highs, but if you look at, we are at the bottom of the table compared to DM or developed markets or emerging markets. So, what's your thumb rule for spotting opportunities after a year of underperformance? Do you follow earnings, valuation, or flows?
So I would say here that it doesn't matter to 99% of the audience here what other countries do. I mean, if America goes
Yes,
up, so
absolutely.
what? So
Uh,
we don't we earn in rupees, we invest in rupees. So what if the dollar has rupee has depreciated? My earnings should grow in rupees, not in dollars, right? Because if you do comparisons with countries abroad all the time, it's
mm,
okay to do it once in a while, but so for instance, 2024, we were probably better than most of the other
mm,
countries. 2025, we're worse off.
yeah,
So if you look at a 2 or 3 year return, then you might see a much different position
sure.
for an India
Mm,
compared to just a 1 year position, right? So I don't think that's the thing. The main thing here is their growth. And there
mm,
is some growth that is happening at a relatively low inflation number,
okay.
which is why I think nominal growth is not so high. It's only less than 10%. But I
Sure.
think inflation should come back to some extent right now. About 2 or
Okay.
3% inflation is possibly
Mm,
where we are going to be at. And that will mean we'll go into double digit GDP growth, and therefore double digit perhaps growth even on some of the earnings, and perhaps eventually on the markets as well.
mm,
More importantly, what do you focus on flows? I don't think flows are going to be easy to predict, but
Sure.
all I can say is it's been a year or more of
Mm.
FI selling.
Yeah.
And it's possible that that selling continues a little more, but I don't
Mm.
think there's that much interest in keeping
Mm.
taking money out of India
Mm.
in meaningful senses. The flows will increase from domestic sources and not reduce. So they will
Mm.
overshadow any of the potential exits. I
Yeah.
also believe that the rupee and the stabilization of the rupee will happen, possibly
Okay.
at lower than levels we're seeing today. Lastly, I think your core idea here is earnings. Valuation is a common criteria, but
Mm.
valuation is to be assessed with growth. We have overvalued a lot of companies that have not grown, and we have undervalued companies that have
Mm.
grown tremendously. So maybe that will reverse because it was the foreign investors who overvalued those companies, like
Mm.
FMCG companies with
Sure.
foreign names who are
Mm.
in India, and it was largely held by foreign investors. Now they are
Okay.
selling, so those companies have,
Uh,
kind of corrected in their valuations. I think they should correct a lot more. And I think the growing companies perhaps will get valued a lot more as well.
okay.
So that's where I think growth and earnings growth is really where the scope of action is.
What is the golden thumb rule for identifying sectors which are actually showing this, the growth phase or the earnings expansion phase, according to you?
So I think you should take longer term views on this in the sense
Sure.
don't look at a 1 year, 2 year, five. It's like a
Mm-hmm.
long view. So to give you an example, I think we're doing really well in the auto sector now. And I think
Mm-hmm.
after years and years of perhaps some layers of protection, we're finally coming to a point where the Indian domestic manufactured cars are coming to a point where they're much better in terms of quality,
Mm-hmm.
handling, ride, effectiveness for the Indian consumer.
Yeah.
And you're seeing a lot of that structure happen. So a lot more manufacturing is happening in India. A lot of the advanced, interiors and the technologies are being
Mm-hmm.
used in India. Auto is a sector I think that has a lot more scope and potential
Okay.
going forward. There
Mm-hmm.
is also the core manufacturing angle where the government's trying to promote layers of, and mostly these are B2B companies that are
Mm-hmm.
either into chip manufacturing or PCBs or electronics or even just
Mm-hmm.
electrical back-end manufacturing. There's infrastructure where I think the government is finally starting to invest again
Mm-hmm.
meaningfully. Even the private sector is trying to get ready for capex given the lower
Yeah.
interest rates. So these are sectors that you should watch out for in general.
Mm-hmm.
I think these are long-term plays, like 5 to 10 years. They
Okay.
should give you a good and solid long-term potential. I feel some of the financials may be a little overvalued
Mm-hmm.
at the ones that were traditionally a large
Mm-hmm.
private sector bank kind of levels. Their
Okay.
growth is not going to be as much, but some of the smaller private sector and
Mm-hmm.
perhaps some of the public sector banks will
Mm-hmm.
probably do really well in terms of growth because they have
Okay.
started from either they have a good big base and they've never really monetized and
Mm-hmm.
now they figured out how to. And in the smaller private sector banks, they're just more nimble and they're able to use technology much better than some of the larger private
Mm-hmm.
sector banks.
And for someone who wants to sort of deploy a fresh capital at this point in time, so what's your thumb rule for deploying capital or fresh capital in 26? Lump sum, staggered buying, or stricter allocation caps?
So
What do
I
you
would
think?
say you should diversify in two ways. One is
Okay.
across market types and
Mm-hmm.
across market approaches. So you want a smattering of, say, asset allocation in terms of equity, debt, commodities
Mm-hmm.
like gold and silver and so on. That's your broad asset allocation framework. Then once you decide you want to allocate so much to equity, within equity, you're going to say, well, I'm going to do some India equity, some non-India equity, and non-India equity makes sense after you pass around a crore of assets, right? So
Sure.
you're going to build your first crore with Indian assets. And then after that, you're going to have some money that you can send abroad because sending abroad costs a lot of money.
Mm-hmm.
And
Costly.
you don't, you can't do 1,000 rupee SIP abroad
Yeah.
because it costs you 1,000 rupees to send 1,000 rupees abroad. And so once you decide that you want to do India, then you want to do large, mid, and small cap, like, or a
Mm-hmm.
flexi cap kind of an approach where
Mm-hmm.
a fund manager will choose for you between large, mid, and small. And you
Mm-hmm.
need bits of all because I think small caps and mid caps will do really well in the next decade. So you need a
Okay.
bit of that as well. This would be the light, market type of an approach. The other approach is how are you selecting these,
Mm,
stocks or areas within them. So if you choose a flexi cap fund, you want to choose something that is,
mm,
maybe there's a set of fund managers who say, well, we will analyze every
mm,
company, look at it fundamentally, and then buy some. That's one approach. That's worked very well in the past. There's another approach that we are following, which is more quantitative. Let the data tell us what to buy and what to sell. We are not going to try and we're going to try and make the least amount of subjective decisions. So we
mm,
make our algorithms that make those machines. So you have a quantitative approach, you have a fundamental approach. There are others. For instance, in debt,
mm,
you have an accrual approach, you have a duration approach. So you
mm,
might say, I want to buy debt at a 7.5% yield and hold it all the way till
mm,
maturity. Or
mm,
I think interest rates are going to come down and therefore I'm going to buy this today at whatever yield, but I know that the yield will be lower tomorrow. So I don't care about
sure.
the yield so much. The approach matters here.
Mm,
So the approach of a fundamental investor, maybe X, there are 4 or 5 fundamental approaches. If you did this once a year, that is more
mm.
than enough. After that, is just follow the process. Let the
Follow the
markets go
process.
up or down. It doesn't matter. Just keep
Mm.
following the process.
Absolutely. And good that, in the conversation you brought about the Capital Mind Mutual Fund, because I wanted to ask you that it is a relatively new entrant and having launched just last year. So how has the journey been so far in the market that's seen significant volatility?
It's been an interesting time. So we started in August. So
Yeah.
the first since then it's the market's probably up about 4 or 5%. We're in the last quarter. I think we're up about 6.5% on the flexi cap fund. Top quartile in terms of performance and
Sure.
has done better than the index in the same time frame
Mm,
in the
mm,
last quarter. But it has come on the back of some serious volatility. One of the things that we've learned is we should do this in the PMS as well, that
yeah.
volatility is a feature, not a bug. We
True.
use that data and
Mm,
we do a combinational things of multiple factors. We call them factors. Every stock
mm, mm,
may represent a certain value in terms of low volatility or
mm,
momentum or quality. We use these as numbers to kind of
mm,
figure out what our portfolio should be at this time. And we use something called regime switching. But what it
okay.
is doing for us is, the data has actually revealed a lot
Mm,
of interesting things that we didn't think that was possible. That
okay.
imagine, of course, there was
Mm,
no way we could have predicted this, but an exchange that does commodities has done exceedingly well in the last quarter. That's also because gold and silver have gone up so
yeah,
much,
yeah. Absolutely.
right? But even before they went up so much, the
Uh-huh.
exchange started to perform even better. And
Ah,
it was the data that kind of popped that up first for us without
right.
us even actually looking at, why was this happening? So
Uh-huh.
it's a very interesting part where sometimes the data reacts before you understand why
Mm, mm,
the phenomenon or the underlying circumstances are changing.
mm,
I think that is going to be, I mean, that is our view, is that let that quantitative algorithm run, and over time it does give you
mm,
good returns from a market
mm.
standpoint.
My final question would be to you is, Capital Mind has long been associated with a data and rule-based investing approach. So how does this philosophy sort of translate when managing public mutual fund capital at the AMC level?
So I think there are two parts. Firstly, you should have rules and you should stay disciplined to those rules. And
Sure.
second, you should definitely know when, I mean, you have the experience to understand when the
Mm,
rules are need to be modified or changed or broken sometimes.
mm,
Because sometimes the data may not capture everything that you are aware about in a stock. I think in the long term, because of these
mm,
slightly changing factors on a thing basis, so we need
mm,
you know we have an overriding philosophy that says,
mm,
be follow the rules and don't
mm,
get
mm.
married to the stocks that you own. So the
Yes.
stocks don't know that you own them, so you don't
Mm,
have to keep buying
mm,
them. And the other one is, assume that you'll be wrong a lot, because you
yeah.
can make very precise calculations of where earnings will be or where
Uh-huh.
markets will go. But 90% of the time you'll be wrong. So you
Right.
have to work with ranges. So, this is
Sure.
this is the range of expectations that I should have. and I will be somewhere among those range of expectations rather than something exact. So some of these philosophies lend themselves into our data oriented framework, but add a layer of subjectivity on top that says, well, because it's very easy to say, why am I selling this stock? This is such a famous bank. But if the data is telling you to sell it, you have to sell it. And you have to buy something else that it's telling you to buy. And I mean, it's not because we don't like the stock. It's because the data has changed and we have to change according to that data. I think that is core to our philosophy. But of course, the issue is in times like this, there will always be these turning points when the data is changing, but the time it takes to change makes for a little more. So we will never be able to pick the exact bottom of a market or sell at the exact top.
Exact top.
We know that by and large we'll miss the first 10% in both directions. But that's fine because the money is made in the 80%, not in the 10% below and 10% above.
Right. Rightly put there, Deepak. And on that positive note, well, that was indeed a fascinating conversation as usual, and especially your framework on navigating growth versus value and staying disciplined amid global noise. Thank you for joining us on the Golden Taboo, Deepak. Thank you so much for the time.
Thank you, Kshitij.